Hello and welcome to today's quick video, which is called S&P 500 Bull Power. And that's what we are seeing because the expectations and actual policies and prior trends as we head into the first days of the new administration are clearly there. You pretty well know my site, rich Twitter feed. Thank you for liking this video and subscribing to the channel. You had already seen on the weekend presentation this chart where I talked yields and how they performed throughout the week, and the local top that was marked on CPI when yields started to retreat on the heels of calmer than expected core CPI, bringing forward rate cut expectations. This is the pre-market chart of short-term bond aggregate, which means the higher the price, the more valuable those bonds are, meaning the lower the yield is. And ever since CPI, yields have been retreating, which means bond prices had been rising, and after inauguration we saw them retreat even further, and now the move is being somewhat faded. What is, though, the key currency pair to be watching? It is, of course, the Japanese yen, where we are seeing some expectations of Bank of Japan stepping in to defend its own bond yields and help the yen to rise. And we all know what it had forced in early August last year, which coincided with the local bottom in this 10-year chart that is formed above the letter G of the word high in the annotation. So we have this effect of Bank of Japan that is forcing yields to retreat, and for now reflecting the trajectory of the economy and positioning for elections and their aftermath is leading to steeply rising yields. So why are these yields rising? These have risen since greater economic growth expectations, deregulation, business-friendly policies, and of course this would be feeding inflation expectations, and inflation has already proven to be sticky. Looking at the big picture, we see that the long bond market bull that had started in early 1980s had come to an end with its Corona era overshoot to the upside, and ever since it started even before the Fed started raising rates in March 2022, we had seen yields moving higher. The counter-trend move that had sent them back to the downside in late summer 2022 coincided with the counter-trend top in S&P 500 within its own bear market, cyclical bear market. Ever since then, yields had been steadily trending higher, and it coincided with the sharpest rate-raising cycle ever since the mid-1990s that the Fed had embarked on to tame the galloping inflation ushered in by the Corona-era policies. As for US dollar, Japanese yen currency pair, on this 4-hour chart we see no panic in rushing to the yen and forcing it to rise. US dollar is similarly, but even stronger, even more so, strengthening versus the euro ever since the inauguration, which means that the self accompanying the situation approximately 24 hours ago had been overcome, and the US dollar is still trending higher, which is of course good for domestic companies, but for now Russell 2000 is not outperforming S&P 500. Tech, though, is understandably lagging, so all the multinationals, such as, for example, Microsoft, that have to repatriate their worldwide profits, are lagging, hurting relative to those companies that derive most of their profits domestically. You remember these charts of market breadth on the daily, which I had covered in Saturday's video, and the sectors why I was trusting the S&P 500's upswing to continue, and it was thanks to financials. You see that tech is relatively lagging, but industrials very encouragingly kicked in. So review Saturday's video where I am diving in greater detail. Here we see that since the FOMC delivery, marking the longest red candlestick on this chart, S&P 500 has almost fully retraced it, and the flush in Asian session hours had been very readily bought in S&P 500. The similar applies to Nasdaq and still underperforming Russell 2000 as well. I've already talked the broadening breadth and repositioning towards more better exposed sectors, which I'm covering for clients, and of course gold is liking the retreat in yields as well and reacting to it pre-market with upswing continuation too. So it is only the multinationals that are kind of suspect, and I expect market breadth to be broadening, which means that you can watch equal weighted S&P 500 and Russell 2000 for when over the weeks ahead these gain greater traction than they are rising with currently. My join page to help you select what's right for you, one-on-one direct support on Telegram, and be my guest at the Twitter feed, fielding your chart requests, comments, questions, whatever you need to know and are interested in. You know my journey, obligatory disclaimer, and let's talk again soon. Thank you.